Here's some advantages and disadvantages of hard money. First off, the advantages. OPM, other people's money. You're using the power of leverage in your real estate investing business. So anytime that you're using other people's money, it's a great opportunity for you to get into more deals. Based on the property, hard money loans are based on the deal, the property, not the person. Not the person borrowing, the actual deal. So if you bring a great deal to a hard money lender, they're going to take a look at it and they're going to say, wow, this person's got this property at a great value. Yes, I will lend you the money to buy the property and do what you will with the property. And so it's not based on the person like traditional loans. Whenever you walk into a bank and you fill out a credit application, not so with hard money lenders. Based on the deal. The hard money lenders knows that if you default, they're gonna take that property back. And ultimately, they're looking at the deal and saying, wow, there's all this equity involved in the property, so they feel safe about it, feel good about lending. It's fast. Hard money lenders typically have a large reserve of cash so that they can lend out to investors. And I've had hard money lenders, I've shown them a deal, and 3 days later, literally closed it with cash from a hard money lender. Not on your credit. So if you do plan on using your credit, a hard money lender could report that loan on your credit. The ones that I've used, I've never seen them go about that process, but typically those kind of loans aren't going to be on your credit, so it's not going to tie that up at all. Let's hit on some disadvantages as well. So short term. I've found a lot of hard money lenders will give up to 6-month terms. Every hard money lender is different. One other hard money lender that we've worked with, we've negotiated longer terms. That if we go past the 6-month mark, then our rate increases a little bit. So it's going to be on a person-by-person basis. But you'll just, when you approach a hard money lender, they're typically going to have all their terms laid out and say, here's the type of hard money loans that I lend on. Here's all the details. High cost. You are going to be paying typically a high rate. You may pay anywhere from 14 to 18%, and points. What is a point? It is 1% of the loan. So if there's a loan for $100,000 and the lender charges 5 points, well, on top of the interest you're paying them an additional $5,000. Also, today's market, whenever you receive a hard money loan, the first thing that should be in your head is, what's my exit strategy or strategies? How am I going to get out of this loan? Today's market it's a tough time to sell property. So if you take on a hard money loan with the sole exit strategy of buying and selling the property within that limited short term, you better have a great deal under contract so that if need be, you can lower that price and get rid of it quickly to cash that out. Maybe you have a backup financing strategy with a private money lender or conventional financing. Not sure, but just know that when borrowing, these loans can be used very effectively, but multiple exit strategies is the best way to go about it. And although high cost is a disadvantage because there is better money out there, what's the cost of not getting a deal done? Again, you could lose 20, 30, 40,000 by missing a deal rather than paying that high interest. So a lot of times we just consider it just part of doing the deal. So we factor that in when we negotiate it.